Hi, I'm Jimmy. In this video, we're looking at dividend yield on cost, what it means, and if it's a good thing or not for us to consider, and if it is good, how can we use it? And then hopefully we can take this information and make slightly better investment decisions and ideally get us closer to our goal of achieving financial freedom. Okay, so let's jump right in. So what is dividend yield on cost? Oftentimes we'll hear this called just yield on cost. It's the same thing. Okay, so first, let's look at how we calculate dividend yield. Then, yield on cost is fairly simple. Now, this works with ETFs or stocks. The process for both is the same. So first, we take 12 months of dividends per share. This could be the past 12 months. In that case, they'll call that the trailing 12-month dividends per share. That's the most common way to do it. Or we could even take the next 12 months, the expected dividends over the next 12 months. They call this forward dividends per share. But the past 12 months is the most popular, so let's go with that one for our examples. Okay, so now we take our dividends per share and we divide that by the current stock price. And this gives us a current dividend yield. So let's look at a quick example like Coca-Cola so we can see how this works in action. So over the past 4 quarters, Coke has paid four different dividends. They total up to $1.62 per share. So we take that $1.62 and we divide that by the current price, which is about $45 per share right now. And that gives us a dividend yield of about 3.6%. But now let's ask a question. What if their stock price rises up to $60 per share? Well, assuming the dividend stayed the same, our price would go up from 45, we'd switch that over to 60. And our dividend yield, just like that, drops to 2.7%. Because it's the same $1.62 in dividends divided by a new higher price of $60 per share. But does that new price really matter to us? We paid $45 per share, so our dividend yield on cost is still 3.6%. And for those of us who like to think of this in terms of math, well, now the yield on cost formula is the same dividend, past 12 months in dividends, we divide that by our position cost, not the current stock price. So if we paid $45 per share, no matter what the current price is, we stick our average cost for that particular investment into the formula, and this doesn't change unless we buy or sell shares. One good example of this is Warren Buffett's purchase of Coke. This is a screenshot from Warren Buffett's most recent annual shareholder letter. And if we look at the Coca-Cola line item, well, we can see that he spent about $1.3 billion to buy 400 million shares. That puts his cost basis at $3.25. And given that we know that Coke has paid about $1.62 over the past year, well, that gives Warren Buffett a yield on cost of about 50%. Okay, now our question is yield on cost a good thing for us to consider? Well, like most things in investing, and probably in life as well, there's pros and cons to using any one metric. Yield on cost is just the same. One negative viewpoint of yield on cost, and they say that it's a silly way to look at a dividend yield because basically, sure, it cost Warren Buffett $3.25 per share to buy that stock, but it's worth $45 per share right now. So right now, Warren Buffett has $45 per share tied up to earn $1.62 in dividends. And the argument goes that if Buffett sold his shares today and bought something with a current dividend yield that was higher than Coke's current dividend yield of 3.6%, well, he could earn a bigger bang for his buck when it comes to dividends at least. And this is a very logical argument, but it could be missing a few other important considerations. So if Buffett sold his Coke stock, well, he's going to have one heck of a tax bill for the long-term capital gains that he has accumulated. But also, the assumption with the debate that yield on cost isn't any good is that Buffett can easily find a better place to put his capital to work. Sure, he can get a higher dividend yield, but I'm fairly certain that's not his only consideration. So while I do think it makes sense for us to always question, are we better off holding this company, buying more, or selling it, I'm not sure it makes sense to completely ignore the fact that selling any particular investment, at least any profitable investment, would likely bring on taxes. And it would bring on the need to replace that investment in our investment, or that holding in our investment portfolio. Now, on the flip side, and the debate on the advantages of using dividend yield on cost, and I've actually had some personal experience with this type of thing, and that is I was helping some family members set up a dividend portfolio for themselves. They're retired, and they told me that they needed to earn at least 5% in dividends each year. Okay, so we have to put together a portfolio, and if I remember correctly, their portfolio was set up to earn about, at the end of the day, it was about 5.5%. We built in a little bit of buffer room to make sure that they consistently hit their 5% dividend yield. And I should point out that in that particular portfolio, I used only ETFs to make sure that they stayed plenty diversified. Well, shortly after that, we put together the portfolio, that we invest in it. And shortly after that, the stock market starts doing what it did, and the ETF prices start moving all over the place. Some up, some down, some even had wild spikes or wild drops. But I kept trying to convince them to stop watching the daily price changes of each individual stock. We know what we paid, and I had picked ETFs that I thought the dividends would be safe in the long run. So any shifts in today's price was somewhat irrelevant to our personal dividend yield. Put another way, no matter what the ETF did, the price of the ETF did from day to day, our dividend yield on cost would stay the same, as long as that dividend stayed the same. And if it got better, good for us. Our dividend yield on cost would go up. And hopefully the dividends that were being paid don't go down. If they did in that case, well, then our dividend yield on cost would go lower. So in my mind, this was a very appropriate way of using yield on cost. Once we locked in our cost basis, well, the only thing we need to watch from that point is the consistency of their dividends. And yes, even if our ETFs or our stocks go up in value, well, it could make sense at some point to sell those investments and replace it with something better if we think we have something better. But for me, that's not a yield on cost decision. That's a quality, an overall quality of investment decision. So in that scenario, I wouldn't be clinging on to our position. If we're Buffett and we have Coke like this, I wouldn't be clinging on to the Coke position because we have a high yield on cost. I think that is a silly reason to stay in a position, but I don't think it can be completely ignored. I just think it's one of the many factors to consider. Do we have a better investment? If we do, then perhaps selling it makes the most sense. Now, if we're curious about the dividend portfolio that I put together for my family, it was a few years ago when I put that portfolio together for them. If you're curious, please let me know in the comments below. I could do a video on that if you're interested. And if you're wondering what was in that portfolio, well, yes, I did put in there the high dividend ETF that I was creating, called the Granite Shares High Income ETF. The ticker symbol there is HIPS. Now, I actually did a video on how a dividend ETF is created. If you're curious, perhaps that could be a good next video for you to watch. I got a link right here. I got a link in the description below. And thank you so much for sticking with me all the way to the end of the video. I really appreciate it. Thanks, and I'll see you in the next video.